Hi guys, today is the day. I'll finally reveal my whole dividend growth portfolio. Some of you have been asking for this for quite some time already, and I have been thinking about this video a lot because I think just showing my portfolio is not enough. For full transparency, I also want to give you a bit of insights into my strategy and my reasoning behind what I'm doing so you can put it into context. And not only that, I also have a very concrete goal of what I want to achieve with this, and actually just reached my first milestone last quarter by reaching my first 100k euro. But this is only the beginning, because my long-term plan, but not my final goal, is to bring this portfolio to 1 million euros and even beyond that. So today's video will only be the first step, and from now on I will make regular updates so you can join my journey and see how it goes. I at least hope that it goes reasonably well because, well, a lot of my money is at stake. And if you're new here, my name is Florian. Welcome to Cashflow Maniac. Before we go too much into the details of the portfolio, I'd first like to take a step back. Because before talking and judging about individual stocks and portfolio positions, I think it is crucial to understand and define your personal investment strategy and goals first. For me, investing serves 4 goals that are ranked from the most to the least important. The first and most important is being financially independent. Yeah, I know. It's not very creative and sounds a bit mundane. But the goals don't need to be very creative. For me, financial freedom means to be able to do what I want and when I want it. It does not include a private jet or yacht. So, to be a bit more concrete, in order to be financially independent, I want to be able to pay the costs of living for my family and me from passive income. And I use the term passive income very loosely here. This includes dividend payments from my investments as well as the income from 2 rental properties that I also own. In the future, I could imagine that it also includes other forms of income, but let's focus on stocks today. Of course, this is a very long-term goal and it is not reachable with investing alone. But even though my grey hair suggests otherwise, I am still in my 30s, although just barely, and have no plan or intention to stop working in the next years. So I don't need the passive income now and am reinvesting all my dividends back into my portfolio to get the dividend snowball rolling. That is also the main reason why I focus more on dividend growth instead of dividend yield. Because a high yield would just mean that I have to pay taxes on the dividends before reinvesting them. My second goal is to limit unnecessary purchases. This is actually quite an easy point for me, as I either way don't spend too much money on stuff and never have. Before spending my money on stuff, I'd rather spend it on experiences like vacations. I value my personal freedom so much higher than any worldly possessions that it's basically my second nature to focus on becoming financially independent. I still do have some costly hobbies like photography, for example, where new equipment can easily go into the thousands. And if I really want something, I will buy it. But I try to avoid purchases of things that I only use a couple of times and don't really need. And even though I find this point quite easy, I can't even spend the money that's not in my bank account. So I shift the majority of the money I earn and that I don't need to cover my basic costs to my investment account right away. This way, I don't even get tempted to use it for stupid and unnecessary purchases. Because of this, some people would probably see me as a frugalist, even though I wouldn't count myself as one. My third goal is to be able to act on opportunities. This is a bit vague and I don't have a clear target or plan here. But the opportunities I'm talking about are investments or business opportunities. Finally, my fourth goal is to grow my personal wealth over time. And this might sound a bit stupid, but I just like to see the number in my spreadsheet going up from year to year. This is actually a bit similar to the dividend payments that, for me, should also be growing each year. These goals have led to my investment strategy that is more focused on a diversified portfolio of stable companies that pay a growing dividend and is probably a bit more conservative than a portfolio that, for example, focuses purely on quickly growing but also much more risky tech stocks. It is also the reason why I'm investing with a time horizon of over 10 years in mind. That means specifically that I am targeting a portfolio with enough diversification, not only over different sectors, but also different geographies and market capitalizations. And that also means that I specifically want to include small and mid caps in my portfolio, as many people actually don't. I still want to have stable companies that have either a competitive advantage or are market leaders in their segments. But we can not only find such companies in the mega cap space. They can also be smaller ones like hidden champions, for example. As a third point, I like to see companies that are operating in sectors with secular trends, as it is always easier to swim with the current than against it. And last but not least, because my ultimate goal is financial freedom, I am looking for companies that pay and even more so grow their dividends. But I have not only defined what I look out for. I also find it important and handy to know what I want to avoid. And here I have also defined 4 points for me. At first, I try to avoid hype stocks or highly valued stocks. This is important because, statistically speaking, lower valued stocks produce higher returns to their investors. I don't have a concrete threshold here because this can also be a double-edged sword, and I want to limit the chance of missing a great company only because of a high valuation. I also don't buy companies that I don't understand, which is also the reason why I talk about the business models in my stock analysis. I just think that it's very important to understand what a company is doing and how it is generating their money before looking at the numbers. The third point, and this is a hard pass on me, is that I'll never invest in companies that are not profitable yet and don't produce cash flows. And last but not least, I also try to avoid companies that are diluting their shareholders because I'd rather own a company that is avoiding their investors instead of punishing them. So now you know my investment goals as well as my strategy and investment rules that I have for myself. So it's about time to drop my pants and show you my full portfolio. First, even though my focus is on individual stocks, I also own a couple of ETFs. We will get into the details in just a second, but the rough split between ETFs and individual stocks is 76 to 24. And full disclosure, I exported these numbers by the end of October, so the changes that occurred during the last week are not yet included here. The ETF part consists of 3 ETFs. The first one is the S&P 500, and that is also the only one where I have a monthly savings plan running. So I invest a couple of $100 each month into this ETF as kind of a long-term dollar cost averaging. And because I want to be globally diversified, I also added the MSCI Emerging Market ETF, but here I don't have a savings plan running. I am targeting a split of around 70% S&P and 30% MSCI Emerging Market. At the moment, the volume of my Emerging Market ETF is quite a bit above my target allocation though, so I'm not putting any money here until it roughly reaches my target. The third one is actually a thematic ETF for cybersecurity. The iShares Digital Securities ETF based on the ISE Cybersecurity Index. This is a bit of an exotic investment in my portfolio because I usually don't like such thematic ETFs too much. I'm also a bit torn if I should include this in the ETF section or rather the stock section. The reason I choose this ETF is because I think that this field is a very interesting and important one that has a lot of growth ahead of itself. I just couldn't decide on any individual company to invest in. So in the end, I choose this ETF. But from a capital allocation point of view, this investment is in line with my target allocation that I have for individual stocks and not for ETFs. And speaking of individual stocks, let's come to the most interesting part, the individual stocks that I own. At the moment, I own 18 stocks in this portfolio, and as full disclosure, I also own 2 other stocks in a different and much older portfolio. But contrary to this portfolio, I just let the other 2 stocks run without even looking at them much, and the total value is also much lower than this portfolio. For now, let's go through this portfolio from the worst performer to the best performer. And I am looking at the total relative performance. So the total return including the dividends I received in percent. The first one and my worst performer with minus 19% is Energiekontor. This is a German utility company and makes up around 4% of my portfolio. They plan, construct and operate wind and solar farms. So they are designing and developing solar and wind farms, of which they sell about half of the finished projects, but also keep the other half for themselves and operate it by themselves. They were founded in 1990 already and are a pioneer in this renewable energy field and have a lot of experience. The stock of the company has struggled in the last 2 years and is now down more than 50% from their all-time highs in 2022. But the fundamentals are still strong and growing, and they are also growing the dividends insanely quickly with almost 25% annually for the past 5 years. They are also paying a dividend of 2.4% and have a low cash flow payout ratio of only 10%. What I like about the company besides the dividend growth is their huge experience in this field and also the unique business model. I also believe that the growing energy demand combined with the net zero targets in Germany and many other European countries gives them a good upside. It is also helpful that Europe is increasingly focused on becoming more independent from energy exporters like Russia and the United States. My second worst position with currently minus 8% is Dassault Systems. This is a fairly new position for me that I just entered this summer. Because of this, it is also still a smaller position that only makes up 2% of my total portfolio right now. Dassault is a French company that is most famous for its CATIA software. They are a global leader in 3D design and PLM, product lifecycle management software. And while their biggest competitor Autodesk is focusing more on the engineering and architecture side of 3D design, Dassault's focus with different software is more on the product design, virtual planning and modeling the manufacturing process in general. The company is also down quite a bit since its highs. One of the reasons is that some of their major customers are European automotive companies which are struggling right now. But there is a huge general trend to virtualization and digital twins, and I believe that Dassault, as a major player here, can benefit greatly over the next decade or so. My next position is also the last position in red and my newest one, as I just bought into it 2 weeks ago. It was actually also one of the first stocks that I analyzed on this channel almost a year ago, and I have been waiting for the valuation to come down a bit for over a year already. So now I'm finally a proud owner of a small part of ASML. They are working in the semiconductor manufacturing market with a market cap of 265 billion. My position is still very small and makes up only 1% of my total portfolio. So I'll also keep adding to this one over the coming months. ASML is paying a small dividend of 0.85%, but they have also increased this very significantly over the last 5 years. The cash flow payout ratio is a bit over 70% right now. ASML is the market leader for semiconductor manufacturing equipment, where they offer very advanced systems for lithography, metrology and inspection. With their EUV machines, they are also the only ones that can produce the most advanced lithography machines that are necessary to manufacture the most advanced chips. And these machines give them a huge moat. But the outlook for the rest of this year and the first half of next year is not so good, and because of this weaker outlook, the stock crashed after the last earnings call. But I don't think that this changes anything with the quality of the company, and thus I think that this weakness is a perfect time to buy. Next on my list is with Surgical Science Sweden, a very interesting small cap. They develop and sell software and simulation systems for the surgical robot space. Their most well-known customer is probably Intuitive Surgical, who uses surgical science software for the training and operation of their robots. They are also a smaller position in my portfolio and make up around 3%. I started my position by the beginning of this year, and since then, the company has been going mostly sideways. So, from a total return perspective, my investment has delivered a black zero. It is also the first company that is not paying a dividend at all, but I find the medical robotic industry a very interesting one and think that Surgical Science Sweden has a prime position to benefit from the secular trend to more robosurgeries in the future. Next on my list is Deutsche Post or DHL. They are in the green with 1% total returns. This only comes from the dividend payments because the price is actually down a bit since I bought them. It is also one of the first investments that I made for this portfolio. Back then, my focus was more on higher dividend yield instead of dividend growth. DHL makes up around 5% of my portfolio and is working in the transportation sector with a market cap of 42 billion euro. They are paying a quite high dividend with almost 5% yield and could also grow this with over 70% per year over the last 5 years. And while this might sound much lower than the last couple of companies, their starting point is with 5% yield much higher. On a global scale, they are by far the market leaders in express deliveries and can benefit from long-term trends to globalization and e-commerce. Their supply chain segment is also offering customized solutions including warehousing, transport or other related services. But as I mentioned already, the stock has been trading mostly sideways in the last couple of years and has not produced great returns, which is also due to the general weak economy and especially the China weakness. As a cyclical stock that is very dependent on the global economy, I'm pocketing the dividend while waiting for the economy to recover. The next stock, and also the first financial stock on my list, is Visa, with a market cap of $580 billion right now. They make up around 7% of my portfolio and are slightly overweight. They are paying a small dividend of only 0.7%, but could grow this very nicely with 15.7% annually over the last 5 years, while still keeping the cash flow payout ratio at a low 22%. They are providing digital payment services and are a cornerstone of modern global commerce through the transfer of information and money, and are often described as a toll booth company for global money transfer. They basically have a duopoly on this market, together with MasterCard. The stock is also going up nice and steadily, and the only reason that my total return is not greater here is that I just increased my position that I already owned for quite some time, very significantly some months ago. Also, please remember that this latest leg up is not included in the numbers in my Excel sheet yet, because I froze the numbers by end of October. The next stock, and also the only REIT you will find in my portfolio, is VG. They are a specialty REIT that famously owns many prestigious properties on the Las Vegas Strip, like the Caesars Palace, the Venetian and the MGM. But not only that. They also own a couple of golf courses and other entertainment-related real estate. This position also makes up around 7% of my total portfolio. They are a great dividend payer with 5.2% yield and a dividend growth of 7.6%. But as a REIT, it makes no sense to look at the cash flow payout ratio, so I left it open here. I've been traveling to Las Vegas several times in the last couple of years for my regular job, and even during the pandemic, the city and especially the hotels on the Strip have always been very busy. So I think with their high quality properties there, they have a great base from which they can and do expand. Unfortunately, the stock has still performed quite weak over the last years, which also might be due to the higher interest rates that affect REITs especially. Now, with the start of interest rate cuts, the stock might start going up again. But as an entertainment REIT, it is also very dependent on the general economy, so let's see what next year brings for them. The next stock with a total return of 10% in total is NextEra Energy. They are one of the largest energy provider on the US East Coast. Recently, they are also making huge efforts to switch to 100% renewable energy production and are actually already the market leader in the US for green energy. This position makes up 6% of my portfolio. They are paying a nice 2.4% dividend and could grow it with a CAGR of 10.5% in the last 5 years. Their cash flow payout ratio is at 33%. For NextEra Energy as well as Energiekontor, I actually use the operating cash flow to calculate the cash flow payout ratio instead of the free cash flow that I use for all other companies. Because this makes more sense for utility companies with their often high and irregular capex cycles. Since I bought the stock a couple of years ago, it has crashed and recovered again, and the returns I made are mostly coming from the dividend payments. And even though I still think that there is a huge secular trend to increased energy demand as well as renewables in general, this is currently one of my lower conviction stocks. Mainly because their high capex demand for the transformation has led to quite a high share dilution that is now higher than what I usually want to see, while their debt has also increased steadily over the last years. So maybe I might replace this company in the future. Next, we come to a stock that I bought roughly a year ago and that has returned 40% since then. This is the Dutch company with the amazing name Koninklijke Ahold Delhaize, and also one of the first videos I made on this channel. They are a consumer staples company and one of the biggest supermarket operators worldwide. They own different grocery shop chains in Europe and the US like Albert Heijn, Food Lion and Giant, and even an e-commerce shop with Bol. They operate all their shops with a modern omnichannel approach and use a lot of advanced technology in their shops to make the life of the customers easier while still trying to keep a local feeling with their local brands. They also pay a nice dividend of 3.6% and could grow it with a high single-digit growth of 8.6% per year over the last 5 years. The free cash flow payout ratio sits at a comfortable 26%. This is a rather conservative stock and I wouldn't expect any huge sudden movements here. But the stock is growing at a very nice and steady pace, and I think that it's currently one of the best consumer staple stocks out there. I will probably make a separate update video about them in the next months to see what changed over the last year. Next on my list with 16% total returns is the mining company Rio Tinto. Similar to DHL, I have had this stock in my portfolio for some time already, and I added it when I was still focusing more on a high dividend yield instead of dividend growth. But despite the time I have had this already, it is still a smaller position and makes up only 3% of my portfolio. They have a quite high dividend yield of 6.5% with a growth of only 5.6% in the last 5 years. But they are not growing the dividend steadily and instead increase or decrease it depending on their operating performance. Rio is one of the largest mining companies worldwide and has a well-diversified portfolio including iron ore, aluminium, copper and recently also lithium. The largest portion of their revenue is done with iron ore though. The resource industry is also a cyclical one and linked to the general strength of the economy. That also explains why the stock has been trading mostly sideways and the performance in my portfolio is only in the middle of the pack, even though this stock is one of the oldest ones on this list. But it is also one of my lower conviction stocks and I'm thinking of replacing it with another resource stock. What hindered me on selling it though is the fact that their profit margins are one of the best in the sector. Coming from a low conviction stock to a high conviction stock that I bought well after Rio, but that could still deliver better returns with 22% since I bought them last year. The company I'm talking about is S&P Global. This financial company makes up 7% in my portfolio. And with a dividend yield of only 0.75% and a dividend growth of 10.4%, we are back to the dividend growth stocks now. Their cash flow payout ratio is also at a low 33%, which leaves a lot of room for further increases. S&P Global is a provider of independent credit ratings as well as benchmarks, analytics, and data for the capital and commodity markets. Their most famous product is probably the S&P 500 index. But what I find even more interesting is actually their credit rating business, which gives them a huge moat. And with their analytics products, I think that they can benefit greatly from the integration of AI into their products. The stock also has a very nice run right now and is up 27% in the last 12 months. I entered my position in my next stock in May last year, and I can still remember exactly when I bought it because I was just on a business trip to Tokyo back then. So I bought my first position of this stock when I was just riding the Tokyo subway. And the company I bought was Texas Instruments. Since then, the company has produced 30% returns. They are a semiconductor manufacturer and make up even 8% of my portfolio as of today. They are a favorite under dividend and dividend growth investors with their long history of dividend increases, and in the last 5 years they could grow it with a nice double-digit growth of over 10%. The current yield sits at 2.5%. However, the cash flow payout ratio appears unsustainable over the long term at 330%. But this is mostly due to some significant investments that also were one of the reasons for last year's dip in stock price. This will not continue forever, and even though I think that the dividend increases might slow down a bit in the next years, the free cash flow should recover again soon. If you're interested in the details and why I think that they are a strong pick, I made a full analysis on them back in June, and I believe that the points I made are still up to date. The stock price has recovered very nicely since its lows in late last year and is currently trading at their all-time highs. With stock number 13, we are entering the upper third of my portfolio now. The cherries on top of my portfolio cake, so to say. The ones that really had a remarkable performance. And the perfect company to start off this home stretch is Danaher. They delivered returns of almost 40% since I bought them, and this is after their drop of over 10% last week. Danaher's position makes up 5% of my portfolio, and they are operating in the healthcare sector where they design and manufacture a huge array of different machines and consumables under several different brands. Together with Thermo Fisher, they have kind of a duopoly in this quickly growing market. They have an outstanding record of successful acquisitions and put a huge focus on acquiring new innovative companies and then integrate them seamlessly into their conglomerate. By doing this, they can increase the profit margins by streamlining the operations with their Danaher business system and leveraging synergies between their brands. At the moment, they pay a very small dividend with 0.43% yield, but they do grow this dividend with a double-digit growth rate. In the last 5 years, the dividend CAGR was at over 12%, while the cash flow payout ratio is also at a low 14%. That still leaves a lot of room for future growth, and with their huge secular trends in the healthcare market, I don't expect this company to go anywhere soon. Next is the only company in this upper third of my portfolio that I just bought this year. It's also the only Chinese company in my portfolio. I am speaking of JD.com. I bought them not even half a year ago, but they could benefit hugely from the stimulus packages that China's government announced in September. At the moment, they are up almost 50%. JD's position makes up 6% of my portfolio. They are working in the consumer discretionary sector and are a provider of supply chain-based technologies and services. The company is paying a dividend with almost 2% yield currently. They have only paid the dividend since 2022 though, so I can't say the 5-year growth rate yet. Over the last year, they have increased their dividend by a whooping 22.6% though. And with a cash flow payout ratio of only 15%, there is also a lot of room for further growth. The stock got a lot of pressure from the weak Chinese economy in the last years and was basically dirt cheap up until the recent recovery. But even today, when compared to some of their peers, I believe that they are still very cheap, but of course, with a Chinese stock, there is a whole different set of risks compared to a European or US company. Stock number 15 is actually one of my favorite companies and my second largest position. It is also the first of the US tech giants on this list. It is Microsoft with 75% total returns. I am not exactly sure what to say about the company because if you don't know it already, you have probably lived under a rock for the last 20 years. I mean, I'm writing my script using Microsoft Word, do my portfolio analysis in Excel, and all this runs on my Windows PC. When I'm done working, I'm saving all my data in the Microsoft Cloud, and I'm even using my Surface tablet to read the script for the video. And I've not even started talking about their cooperation with OpenAI and all their cloud services, which is actually their quickest growing segment. So, as I said, Microsoft is my second largest position and makes up 10% of my portfolio. They are paying a small dividend of around 0.8% and could grow it with slightly over 10% yearly in the last years. The cash flow payout ratio sits at 29%. Same as most other megacap tech stocks, they have had a great year up to now and are trading close to their all-time highs. Coming to my top 3 stocks now, my place number 3 might surprise you. With 1% better returns, they were just slightly better than Microsoft and did produce 76 total returns since I bought them. It is the largest bank in the world, JP Morgan. As a bank, they are of course operating in the financial sector and make up 8% of my total portfolio. They pay a very steady and safe dividend of 2%, but the growth is with 6.9%, not as huge as some of my other stocks. The payout ratio is with only 13%, also pretty small though. They are a bit special in that I will never make a fundamental analysis video about bank stocks here on YouTube. The reason I still bought JP Morgan is that they kind of have a very special position in the banking sector. They are already so big that in general they are not allowed to acquire smaller banks or institutions anymore for fear of becoming too strong. But every time a smaller bank gets into trouble, the US government is asking them to help out and still buy such banks. Just look at the acquisition of the Silicon Valley Bank last year. So you could argue that this is more of a story stock for me. And even though the stock is a bit volatile, they still have a very strong uptrend, and the huge increase of almost 10% earlier this week is not even reflected in my numbers yet because I exported and froze the data for my video by end of October. But even the additional 10% increase wouldn't make a difference in its position either way, because the next one and my number 2 on the list has returned almost 200% since I bought them. It is Meta, and I have owned them for around 2 years now. But despite this insane increase, they are still one of the smaller positions in my portfolio with only 3%. They just started to pay a small dividend of 0.35%, so I wouldn't even count them as a proper dividend stock, and when I bought them, they didn't even pay any dividend at all. Because we don't have 1 full year of data yet, we also can't say how they will proceed with their dividend growth. The payout ratio since they started their dividends is also very small with only 0.62%. I also have a full analysis on Meta, so if you want to know why I bought them, you should check it out. In short, I think that they have huge potential in integrating AI to their products, and I am really impressed about Mark Zuckerberg's vision for the future of Meta. And let's not forget that their finances are also great. But the reason my position size is still so small is that I also think that there are quite some risks for the company. Since the end of 2022, the company has had an insane run and is also trading close to their all-time highs right now. Because of the risks, I currently don't plan on buying more of the company, but I'm still curious where they will go from here. Before coming to my top stock, if you enjoyed the video so far and found it interesting, please hit the like button and subscribe to the channel. As I mentioned in the intro, this is also just the beginning of my portfolio, and I plan to bring it to over 1 million euro over the course of the next years, or rather probably decades. From now on, I will also make regular updates, roughly once per month, where I let you know exactly which companies I buy and sell and my reasoning behind it. So if this sounds interesting, you should probably hit the subscribe button and join this journey from the very beginning. And without any further ado, my largest position and best performing stock with almost 700% total returns is, drumroll please, Nvidia. They are actually also one of the first companies I bought and one of my favorite companies. But as you also can see here, my entry position was very small with just a bit over 1,000 euro, and I never increased it because the stock price just ran away and I made the huge mistake of waiting for a dip to buy more. A dip that unfortunately never came. And not only that, my investment thesis of the stock when I bought it was also actually kind of wrong. Well, maybe not wrong per se, but definitely not the reason for the great performance. Because when I bought them, I was buying the company with the best graphic cards that I used myself for more than 20 years already, by the way, and that showed a great growth and moat in the automotive sector. And I never even thought about AI when I bought them. Well, my reasoning still stands and I believe is still valid, but it pales to the recent success with AI chips. By now, Nvidia makes up 13% of my portfolio. They do pay a dividend, but it is almost not worth mentioning it with only 0.02% yield. They do have a nice growth though, with almost 12% over the last years, but with a very small yield. It will still take forever, even with this growth, to get to reasonable levels. Their payout ratio, on the other hand, is also neglectable with only 0.14%. And the stock, I mean, what should I say about this huge increase? They had an insane run in the last 2 years since ChatGPT kicked off the AI hype. But the craziest part of this is that their valuation is still very close to their 5-year averages. So they are not even as expensive as one would think when seeing this chart. So when we zoom out a bit and look at the whole portfolio, we see again that my biggest positions are Nvidia and Microsoft. But they didn't start out as such large positions, but grew to its current size. In fact, the money I invested in Nvidia was much less than my regular starting position. I will rebalance this from time to time, but at the moment I don't think that any position is so large that I need to cut it for rebalancing purposes. My original plan for this portfolio was to never have more than 30 stocks. The reason is that the effect of diversification on the unsystematic risk diminishes exponentially with more stocks. So, while diversification is very effective up to a certain amount of stocks, the difference each additional stock makes gets less and less with the total amount of stocks you own. I did aim for 30 stocks, the same as Burton Malkiel shows in his book A Random Walk Down Wall Street. But, truth to be told, I am not sure if I will ever reach 30 stocks. Because even with my current 18 stocks, the effort and time that is necessary to keep track with all these companies is already quite significant. So there you have it. My whole dividend growth portfolio. But before you leave, I still have one more thing to show to you. And that is the dividend payments this portfolio produced over the last 2 years since I started tracking it in detail. But before we go there, I would also be very interested about what you think about my portfolio. Which stocks do you like and which ones would you never buy? Please let me know down in the comments. And if there is anything about this portfolio or my strategy that I missed and that still interests you, please let me also know down in the comments so I can consider it for a future video. Coming to the dividends, I track my dividends on a quarterly basis because the monthly fluctuations are just quite big and I would rather smooth it out a bit. And even on a quarterly basis, there are huge differences between each quarter. And here in the list of my companies, you can actually see the only dividend payer that I sold since starting my detailed tracking, which is Medical Properties Trust. And down here in the chart, where the quarterly dividends are added up, We see a very nice upwards trend in the dividend payments, especially when we compare each quarter to the same quarter the year before. We also see that the second quarter is by far my best quarter for dividend payments, and I receive roughly half of my total payments in this quarter alone. This is even easier to see in my dashboard, where I just show the total quarterly dividends without going too much into the details. In total, this portfolio paid me 1,800 euros in the last 2 years, and even though this year is not over yet, around 1,000 euros came from this year alone. My biggest dividend payer is Deutsche Post, followed by Rio Tinto and Vici. And please don't forget, I am not a financial advisor or expert. I just share my own analysis and my own investment strategy here with you. So please, before buying anything, do your own research and build your own opinion. And if you like dividend stocks, you should check out this video where I go over 3 top dividend stocks that are currently quite cheap. That being said, thank you so much for watching guys, and see you in the next video.